Hi, I'm Peter Rose, founder of Longwood Currency Trading. When do you risk it all in a Forex trade? I think that prefacing that needs to be, what does when mean? When is a critical component in the methodology that I teach that comprises, when is part of the creation of a rule. You have to answer three questions: what, how, and when. Those are the three questions that you have to deal with when you're forming your rules. To swing for the fence, which is really what risking it all in a trade, is not within the boundaries of your normal trading scheme. You're not getting into a trade because you say, "Oh boy, this sucker is going to really go, and I'm going to push it all to the center of the table," because that's an improper when of doing an action. The action itself of pushing all your chips to the center of the table is not incorrect. What could be incorrect is when you do that, right? So obviously, if you've been watching my videos, then you know that I've broken the whole trading process up into what I call the life cycle of a currency position. That's a rep against the software development life cycle. I was a software engineer for 33 years. And the SDLC is how you take a complex problem and break it up into smaller chunks and how you solve those pieces and put them together. So the life cycle of a currency position has three phases. Each phase is a problem. You have entry analysis, position management, and exit methodology. Those are the three problems that you need to solve in your from the time you put your trade on, and even before that, until you close it out. When do you risk it all? When do you push it all to the center of the table? It's not at the entry phase. Now, if you're playing poker, a lot of times, if you're doing Texas Hold'em, for example, you pull a couple of aces, you may go all in because you want to get the folks that are weak, that could improve their hands. You want to get them out, and the people that stay, they obviously think that you're pulling their leg, or they've got a pretty good hand themselves, and so they'll stay with you. So then you back off because it shows a little bit of fear. Well, you can't do that in trading, because once you put your chips on the table and you change your mind and you close out, you're gonna lose. So you have to have a higher sense of probabilistic certainty, I guess, that in fact that price is going to continue in the direction that you intend it to go in, and not just for another 10 or 20 pips, but this thing is really going to keep going, and you want to get all your chips on the table so that you have the most amount of your bank, everything, to ride that distance. The problem with that is determining when it's okay to do that. It's just not a probabilistic determination that the price will take off. It's where is your current position value, your average position value, in relationship to the current price. If that distance is less than 20 pips, and you go all in, and it has a minor 10 pip reversal, you're going to lose massively on that trade. Unfortunately, that's what happened to me last year. I mean, I lost 6 figures. I was very resistive to the pullback. I had a big loss again this year. And the when part is the most difficult to determine for pushing all of your chips onto the table. The when component, I have rules that allow you to determine the when properly. But when you're going all in, when you're pushing your whole stack in and looking for that momentum to carry that position far enough to produce a reward large enough for the amount of risk that you're taking. It's not a risk to reward. It's is the percentage that you're going to get. Let's say you're in there for 5 lots, right? And you think, oh, this thing is really going to go, and I'm going to enter another 15, so I'll carry a 20 lot position. Okay, so you're playing at $200 a pip. You're looking for that to go 30, let's say 30 pips. So $6,000. That's what you're looking for. But if your current average position is, let's say it's like 8 pips from your average position, the current price is 8 pips away, and you're going to load in 15 lots. It isn't that you have the expectation of making the 6,000, but if you make the 6,000, does that warrant the amount of your bank that you've committed to that? Basically a $200 per pip investment. If you're trading at 10 to 1 like I do, that'd be $200,000 to play a 20 lot position. So a $6,000 gain warranted on the $200,000 risk that you're taking. It's not really $200,000 because you're going to have to get out of there before the stop hits anyway. But that's how you calculate these things. Because if it goes really bad against you, if the price drops 150 pips in 5 seconds, it's going to take your margin as well. So you have to just say, well, it's $200,000 risk. It's a $6,000 gain. Well, what's 6,000 divided by 200,000? That's the percent of your risk that you've gained. If that's anything over 0.3%, well, you're that's probably okay. 0.5%. I mean, remember, 0.5% on a $200,000 gain. That's pretty good. So 6,000 on 200,000. I figure that out. It'd be 3%, right, on a 6,000 on a 200. So I think you're great in that. But what if you had going into this with a scalper mentality? You'd say, geez, if I load 15 pips in here and I got a 20 lot, 15 lots. If I'd have a 20 lot position, I grab 3 more pips before it hits this resistance point. Man, 3 pips at $200. That'd be great. That's an extra $600 on the 600 that I've already made with the 5 lots that I've had. I make $1,200. Well, that's probably not a situation where the amount of your gain is a valid risk to take. You can't get emotionally involved in your trading. Right? Gordon Gekko had that to say in the movie Wall Street, right? And that's really valid advice. Jesse Livermore said that you don't get emotional, but he did. He made 6 fortunes that were larger than some of the largest net worths that we have today. Not in the billions, but he had positions that were worth hundreds of thousands of dollars. And in his day, that was worth tens of millions. But he'd lose it. He'd go flat and broke. And his statement was, I don't want to lose my position, which indicates that he had the conviction that his position was right and he wasn't going to get removed from that. You can get it right and get it right and get it right and get it right, but the one time that you don't get it right, it'll take the whole thing. It'll take everything. And that's the problem with pushing all your chips to the center of the table, because if you lose more than you've got on the table. Basically is what happens. That's the mathematical term we call it. What is the risk of ruin? And is that risk worth it? If you're day trading, you may come up with, maybe, let's say you're taking 1 trade a day or 3, call it 2. Let's be realistic what you're trying to do in a day trade. Because a day trade, you're only trying to make 10 pips, right? So maybe once a month, that price is going to just keep going. You're going to have a runner, and that runner just looks like it's going to just keep going forever. And you've got other characteristics of the structure of the price around you, the economic conditions, the latest economic reports, they all support this thing really continuing on. And you've been using the methodology that's consistent with good day trading, and now you find yourself in a position where the current price is far enough away from the average position price that you have that if you did go all in, that you would have the sense to get out before that average position so that you wouldn't lose too much. Remember, you're going from a situation where you're 5 lots in and now you're going to add 15. So even if if the price comes down but it doesn't hit what that average price is, you're still taking a loss on 15 lots for that drop and subtracting off the gain of just a few pips from that average position value. And so you're not going to balance out very well. You need to be hyper alert to other things just than what price is doing right now, which is what you'd be doing as a day trader. Because you don't want to get sometimes as a day trader you're going against the major daily trend or the 4-hour trend. So you don't want to get caught off sides on a real adverse pullback, which then goes back against you from there. The volatility just doesn't all of a sudden come out of nowhere. I mean, if you've been trading for any amount of time, you get this larger and larger indication of volatility, and then it'll really start to take off. Even in the pre-release of the NFP, you'll see that happen. But it'll start happening about an hour and a half before that. It'll start going up and down and back and forth as the larger institutional traders are positioning themselves for where they want the price to go when those numbers come out. If they come out against them, they want to be out, so they want that value to be in the opposite position. They want to be holding an opposite level position so that when they get out of that, they make money on being wrong. And if they're right, then they're just going to fuel the move to get that position to move higher. It's all satisfying client orders. They're not hunting your stops or anything like that. But you can play those all-in situations during the NFP if you understand order flow and if you understand the purpose of the institutional trader and what he is doing. What is he doing and why is he doing what he's doing? And you're trying to map out how, if he's sitting there with, it's $6.6 trillion of orders a day that are sitting in the market at that particular time, 15 minutes before that NFP gets ready to take off. That's a lot of meat moving around. And let me tell you, once that position is established as to who's got the winning side of that price could go 160 pips in 15 minutes. I mean, you've seen 15-minute bars like that. I've got them on the videos. I show 15-minute bars that are that. I've got 5-minute bars that are 60 pips. But they can turn around and come back really fast against you. But once that momentum during the NFP, let's say, has manifested itself, you have to understand the economics of the pair well enough that you can understand how far that price is going to continue to go based on, maybe there's an upcoming Fed decision based on the NFP or producer price indexes or coming off a low point and they're having to go up because the interest rates are up, and so you go, oh man, this sets the tone for this could be a couple of weeks of let's say higher prices in the quote pair that you're trading, and that would warrant going all in at that point, but not right as all the shit starts. You have to wait until it goes, but Peter, I'm losing 15, 20 pips. Yeah, but let it go. 15 or 20 pips or 30 pips. And if it's still got that juice, then you go in. But if you try to go in at 10 pips in or something like that, because you're watching a 5-second chart or a 1-minute chart, and the 10 pips looks like a big bar like that, where in relation to just shit dust in comparison to the whole market, you're going to get caught when that thing reverses. Because it'll go 10 pips, it'll go 12 or 15, and you're logging in big numbers, you're right, and all of a sudden the thing turns around and drops 10 pips. And you're holding because you're in a euphoric state. And then it goes to 15 pips below, and you're $200 a pip at 15, and you're gone. Because that's just going to keep going. You'll say, it'll come back. It ain't going to come back. All of the money, the big money that I've lost is over, I don't know that estimating is a good word, but overestimating my reading of the when aspect of these big trades when I go all in. That's not to say I don't go all in during the course of normal trading, because why have a big account if you're not going to trade the big account? You trade it. But those tend to be runner, and you stage into them gradually, so that if you get these retracements, you're only clipping off maybe 2 lots or 3 lots that are wrong on you. What you're doing is you're laddering your way up in your overall position size, and you're all in. I'm not talking about that. I'm talking about getting to a position where you're maybe, as I've mentioned, 5 lots into the position, and you evaluate the situation that this is going to not only be a runner, but this is going to be this is a swing for the fence thing, and at that time you make the determination that you go all in with the rest of your position size, your 15 more lots. When you determine that you should go all in is not when you should go all in. I guess that's the thrust of the video, and probably the most important part. So the secret sauce of this video is when you recognize that there's an opportunity to go all in is not when you go all in. That's the difference. You need to step back from your trading and look at some situations where maybe you did do that, and it was the incorrect reason. Why was it incorrect? What was the distance that price went and then came around and moved against you? How far did it move against you? Did it reverse and go back and continue that? And what were the conditions that caused that to continue? If you're logging your trades, if you're doing journaling, then you're going to have that information. The takeaway from the video is, when you push it all to the center of the table, it's not when you discover that this is an opportunity to push it to the center of the table. The when you actually do it is different, and you have to determine that for yourself. I can't tell you that in a video. This is something that we work with in the coursework that I have. If you happen to be taking advanced solutions, this is part of that discussion that I have in my consulting, is these two concepts of when you recognize something is not necessarily when you do it. Well, it's a lot like in your entry analysis. When you recognize where your entry point should be doesn't necessarily mean that you take the trade right there, because that entry position should be a little bit later for the position to prove itself out. So it's the same concept as in the entry analysis stage that I teach. For those of you that I've worked with, bear that in mind. And you can that's why I say you can extrapolate that up into the push it all to the center of the table event that you may experience later on. Are you going to be pushing all of your chips in a movement like that on a day trade? You may not want to do that. You may want to do a carry and float a stop behind you, because who knows how far that thing is going to go, and you're loaded all in. And you're loaded in at hopefully a very good average position value, and this thing is just floating up there 40 or 50 pips. You drop 10, 15 pips, okay, you get clipped, but you've made 30 pips, 35 pips on a 20 lot, or you make 100 pips or 200 pips. I've lost on positions that have gone, and I've had really large positions and have gone 100 pips against me. Well, why would I do that? Because I didn't want to lose my position. because I evaluated the when wrong, but I really was convicted that the thing was going to turn around and go the other way. But I know how to identify those situations now. Will I still be prone to them? Yes, I will be, but I will get out sooner and take less of a hit than a six-figure hit. Yeah, you know, the cat jumps onto the hot stove and gets burned, but they're only going to do it once. He's not going to get back on the stove again. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.